Got the goal of buying a house but have no idea where to start? Well, if you think you're 1 year or more away from purchasing your first home, here is exactly what I recommend to prepare in this new market of rising interest rates. Hello everyone, my name is Cameron Stevens, the entertainment industry's real estate agent and the owner of Stevens Real Estate, a real estate experience tailored to the creative client. Okay, so you've been browsing Zillow for a few months and you think, wow, some of these houses are ones that I would actually really love to live in. And then you think, wait, I don't have the slightest idea about how to make that happen. Well, guess what? That's most people. So the first thing is, don't worry. This process might seem daunting and complicated, but I'm going to demystify it for you. I'm going to tell you exactly how to prepare, and then when we get to the complicated stuff, I will be there to help and advise until you get those keys in your hand. Before we get to the first step though, let's talk a little bit about timing. See, the last time I made a video on preparing to buy a home, interest rates were at historic lows. And now they've increased quite sharply in a market that looks vastly different than it did a year ago. My advice, however, is not going to change. The best time to buy a house is simple, when the best time is for you personally and financially in your life. The only two mistakes that you can make are purchasing a house that you really can't afford out of fear, just because you're scared of missing out, or if you're trying to wait to time some movement in the market that may or may not ever happen. Therefore, my philosophy on when you should buy is this: time in the market always beats timing the market. The reality is we don't know for sure where the market is going to go. I mean, if interest rates go up, then it is likely that prices will plateau or possibly even dip. But if prices do go down, then your purchasing power went down too with the rise in interest rates, so you're kind of at a wash. If you buy at higher interest rates and then interest rates go down, well, great, you just refinance and you get to keep all of the equity that you've been building up by purchasing that you would have missed out on by waiting. And if you buy a house that you love with a fixed rate mortgage and payments that you can comfortably afford, it doesn't matter at all what happens with the housing market until you decide to sell. That means buy as soon as you're comfortable, buy what financially fits you, and start paying into an asset now instead of paying rent. Okay, so with that out of the way, you know that buying a home is a smart financial decision, but you're at least a year out from buying, maybe far more than that. What do you do to prepare? Well, the first thing is to get your finances in order. Making sure that all aspects of your finances, including your down payment money, credit, any recurring debt, that they're properly taken care of and any potential problems are addressed before you make that move towards a loan pre-approval. Now, I advise my clients to have at least a 10% down payment to purchase a home in Los Angeles. You will incur mortgage insurance on any down payment that's less than 20%, but oftentimes clients, they have difficulty, and rightly so, saving up an entire 20% for the home that they really want. And that's okay, as long as you're making enough money to afford the higher monthly payments that come with that lower down payment. Remember, if you put 10% down, or even if you put 15% down, or somewhere in that range, as soon as you have made enough payments that you have the equity in your home at 20%, you can make the mortgage insurance go away. So do not worry, it's not something that you have forever. Now, how about the monthly payment? Well, your monthly housing payment when you own a home is going to be different than when you were paying rent. Then there was just one check that you wrote, it was a single sum, and as long as you paid it each month, then you're good to go. When you own a home, now you have various costs that together are considered your housing payment. And that's your mortgage payment, property taxes, insurance, and any HOA payments if you purchase a condo or a townhome. Your mortgage payment on a fixed interest loan is the exact same for the entire life of the loan. That's why if you lock in a payment that you're happy and comfortable with, that's fantastic. It doesn't matter. You don't have to worry about it. And if you get, for example, a 30-year fixed loan, then it's over the life of those 30 years. Now, that payment is principal, which is money that pays the loan, and that's money that you get to keep. And then there's interest, which is the cost to borrow that money. Then you have property taxes, which are due in 2 lump sums twice a year. That's December and April. Now you can choose to prepay these into an escrow account so that you don't accidentally wind up at that time and you don't have the money set aside to pay it. Or, you can just pay them in those lump sums online at each of those 2 times. Finally, home insurance. Now, don't let that scare you. Home insurance really shouldn't be more than $50 to maybe $100 per month, especially if you're gonna bundle it with your car and stuff like that. And it's much less than that if you're in a condo or a townhome, because the HOA will actually cover a portion of that insurance under an umbrella policy, and then really you just have to get what's called a walls-in policy, and that just covers everything inside your walls. The rule of thumb is to keep your housing payment no more than 40% of your gross income. So simply take what you make a year, divide that by 12, and then before you have any taxes or anything else taken out, you shouldn't be spending more than 40% of that money on your overall monthly housing payment. Now, some folks choose to stretch that to 50% if they know for certain they have a raise or a promotion coming down the line, or let's say one partner is returning to the workforce. But that really should only be temporary, because remember, we do not want to be house rich and life poor. By the way, if you happen to like videos like these, hit subscribe, hit follow, etc., whatever platform that you happen to be on. That way you can stay up to date for all sorts of great information related to Los Angeles real estate, because that's what we do around here. Okay, so we've looked at down payment numbers and the monthly payment. Let's look at credit scores. So if you don't know your credit score right now, hit pause on this video immediately and go check your credit score. I mean, almost all banks offer it as a free service. There are many online that are free as well. Just type in free credit report and hit search. Okay, you got it now? Fantastic. So chances are you got what's called your FICO score, which is just one of the 3 credit bureaus, but don't worry, it's enough to basically work off of right now. The first major break in loan pricing is for a credit score of at least 720. That's where the big savings come. So that should be your goal if you aren't quite there yet. Now, there is another break at 740. It's not as big as the break at 720, but it's still a good one. So if you're in that range, you might as well try to get it up to 740 and get that pricing break. But anything above 740, it's basically the same. It means that you've got excellent credit and that lenders are going to be happy to lend to you. Now, if you're not at least 720, that is something to fix as soon as possible. Now, usually you can pay off some debt, like a credit card, to boost it up. But some people, they just don't even have enough credit history built up. So there are things you can do, like you can become an authorized user on, let's say, a family member's credit card to build that credit history faster. If you're far enough in advance, you can actually call your credit card companies and ask for an increase in your credit limit, or even open a new credit card and just put a couple of charges a month on it and pay it off in full. In fact, everyone that listens to this video can probably benefit from calling their banks and asking for, let's just say, between a $5,000 and $10,000 increase on all their credit cards. And that's something you can do right now, because look, they're likely to give it to you. And then your utilization rate, which is how much you spend against how much credit they extend to you, will immediately go down. If these aren't good enough options for you, schedule a consultation with me. I've worked with plenty of people to get their credit scores up, but it can take as long as 6 months, which is why it's a great idea to start working on that immediately. See, I have access to a free program that gives us everything we need to do to get your credit score up, whether it's just you're trying to get it up a few points, or if you really need to fix a low score, we can do it all and it's completely free. Finally, we have your debt to income ratio. That's another big thing lenders look for. Your debt to income ratio is basically all your monthly debt payments divided by your gross monthly income. This number is one of the ways that lenders measure your ability to manage those monthly payments, to repay the money that you plan to borrow. So you can start calculating that now, because the magic number that we're trying to hit here is 43% or less. The major recurring types of payments are the mortgage payment, car payments, child support, student loans, and any minimum credit card payments or unpaid balances. They all count towards that. That's why taking a look early at some of these things and possibly paying down things like a credit card or some remaining student loans can have a massive impact on your financing ability. For example, I recently had a client that had a car payment that she could comfortably afford, but having that recurring payment pushed her debt to income ratio higher than the house purchase level that she really wanted. But she had the cash to just go ahead and pay off the car. And then think about this, $500 of a car payment, right, could now go directly towards what she could qualify on a housing payment. And that extra $500 per month qualified her for over $100,000 in extra purchase price. That's a massive change. So if you've been following closely, you'll see a few trends here. Saving diligently, knowing your credit score, and paying down debt. Now, here are a few extra miscellaneous tips to help you achieve all of those things. Instead of the traditional way of thinking about saving, instead you can pay yourself from your earnings and then put the rest into savings. So think about yourself as an employee of your own corporation. For example, at Cameron Stevens, the company, I make a certain amount of money total, which I invest a portion, I pay expenses, and only then do I pay Cameron Stevens, the individual, from Cameron Stevens, the company. This mindset can completely change the way that you think about saving. Knowledge is power, so use a budgeting tool. Start by taking all your credit card statements from the past year, yep, all 12 months of them, and actually seeing what your monthly expenses are, and understand what the average is, understand how much you're truly spending per month and per year. And if you need a little bit more help than that, if you want to go beyond just grabbing your credit card statements, a program like Mint is free and it's great to see what your expenses are, and then you can actually categorize them as well. Then if you're serious about buying a home, consider cutting back on some things for a little while, like for example, eating out or vacations. And you might also look at canceling or consolidating some of those automatic subscriptions and memberships. I know I've been guilty of having a Netflix, a Hulu, a Disney Plus, an HBO account, and then a Spotify account on top of all that. It might be some time to take a look at these and cancel any subscriptions that you're not using regularly. Finally, try the 30-day rule. Oftentimes I'm considering buying something. I will put it into my cart for 30 days. And then if I still really, really feel like I want it in my life after that time, then fantastic, I'll buy it. But if not, and honestly, most of the time it's a no, then I have avoided an impulse buy successfully. If you want to save like a pro, remember most big banks are the absolute worst place to keep money in a savings account, after physical cash that you just stashed under your bed, that is. Instead, use a high yield savings account like Ally Bank that I use, or Marcus by Goldman Sachs is another great one. The numbers might not look that high, but they're actually paying somewhere between 10 and 100 times more on interest for your money than, say, Bank of America or Wells Fargo. If you're more than 2 years out, I highly recommend getting a far better return on the money you're saving by being invested in index funds. Now, I use Vanguard. They have some incredible low-cost index funds that mimic the S&P 500, like VFIAX. I really like them. I know that Charles Schwab also has a great low-cost index fund that mimics the S&P 500 as well. Yes, I know the market has been volatile recently, but go to most domestic index funds and zoom out. Now you're looking at a general upward trend, and that's what we want. We want diversified investments that are going to grow over time. We're not looking for a stock tip that may shoot up and down at a whim. Any money not needed for at least 2 years should be there in case you do have to stomach a downturn of any sort. Remember, we're not buying stocks, we're buying index funds, and you'll be just fine and loving the return that you're getting. And don't look at these every day. Invest the money, just put it there, leave it, no matter what you hear on the daily financial news. Because depending on your savings, this could be tens of thousands of dollars that you're able to add to your down payment. Then, when you actually get closer to buying, you can convert a portion of these investments to your high yield savings account, so they're nice and protected and they're liquid as well. Also, do you get a pretty substantial tax refund each year? That might feel good at the time, but that's money you're giving to Uncle Sam that you don't actually have to. And it made a 0% return while they kept it. So you might want to look at adjusting your deductions so that you're closer to little to no refund, or maybe even a small tax bill, so that you can get more money each paycheck that you can go and put in investments that actually earn money. Now is the time to talk to a real estate agent. I love financial fitness, if you can't tell from this video, and I love helping people prepare to take that next step towards buying a home. But I also realize this advice can be kind of general. I will often put together personalized financial plans and tips and stuff like that for clients. I am not a financial advisor, but I have some straightforward and practical advice to draw on and share with folks. And the last step is to talk to a lender. Now, this just builds off of the relationship that you develop with a real estate agent, because the lender can take a look at all your financial documents, like your tax returns, your pay stubs, and help give you more financial advice on how to maximize your credit score or improve your debt to income ratio. The lender is that last step, as they are the ones issuing you your pre-approval, which is a signed commitment to lend you the money to purchase your first home. Okay, there you have it. Thanks so much for watching. I hope you learned a whole lot about preparing to buy your first home, especially if you are a year or more out from doing so. The best parting advice that I can give is start preparing now, including forming that relationship with an agent like myself early. At Stevens Real Estate, we specialize in working with creative professionals, entrepreneurs, and especially people in the entertainment industry, because I spent 7 years of my life working in animation and visual effects. That's why I designed Stevens Real Estate to be tailored to the creative client. I also designed a few value-adding programs for both buyers and sellers that no one else is offering. For buyers, we put together a full marketing plan that paints you as the right buyer for your dream home. We can help recommend local lenders that will fit your financing situation, yes, even if you're freelance. And do not worry about the inspections. We've got you covered. They're free, all of them, no questions asked. And if you're looking to sell your home, we offer the ability to remodel now and only pay when you sell, with zero fees, no interest, no upfront cost. Plus, we pay for all of the aspects of digital marketing, from photography and drone footage and videography and 3D walkthrough and virtual open houses, social media campaign, custom website, targeted emails, and more. So if you like my energy and personality and think my expertise and programs that I offer would be of benefit to you, please don't hesitate to reach out. And additionally, if you know someone that would benefit by connecting with me, I would absolutely love an introduction. Thanks again for watching, and at the end of this video, there will be a QR code where you can scan it. It'll take you directly to my website, or there will be a link down there somewhere where you can click to learn more.